just want to say hello to everybody and thank you for taking the afternoon to spend the next 35, 40 minutes with me in here and emotions and your money. If you haven't already signed up for next week's Income Savvy webinar, it's one of my personal favorites. That's why I'm saving it for the later part of, now that we're going into phase 2 of the coronavirus recovery plan, as they would say. So it's a really good one. So if you haven't signed up for that, you can go to donotlosemoney.com. And of course, the handouts on the right-hand side, just the services we provide, as long as the tax guide for 2020, if you haven't attended one of the seminars here. I see several new names on here, so I appreciate you guys taking the time of either looking through us from the radio or on Facebook. So I am going to take myself off here and get started. Again, if there's any questions you guys need or have during the presentation, there's a lot of information here to soak up, and you'll hear a couple phrases over and over again. I apologize up front with that, but for disclosure purposes, we have that. But just go to the right-hand part of the screen. There's a questions tab there. So I hope you guys sit back, have your cup of coffee or glass of tea, and get this where it's actually working. Hey, it's working good today. So again, welcome to our presentation on emotions and your money. We all know that emotions play an important part of everyday decisions that we make, especially when it comes to our financial matters. Sometimes emotions can fear can benefit you. For example, scared investors who stayed in cash during the bear market of 07 through 09 may have avoided double-digit losses of 50% or more. But other times, that same fear can cause you to make costly investment mistakes. For example, investors who stayed out of the market through the end of 2009 would have missed out on one of the most impressive equity comebacks in history. In this presentation, we're going to explore different types of emotions that you could face as an investor. Excuse me. We'll also take a look at some of the most common emotional mistakes that people make, and as time-tested strategy and valuable tips that can help you avoid these areas. Now, again, this is myself, licensed insurance agent for yourself, also my radio show on WBT on Saturdays at 4 o'clock. Again, we have a list of our upcoming seminars, Income Savvy, backed by popular demand. In about 3 weeks from now, we're going to be doing the Baby Boomer Basic, which was an overwhelmingly huge one. So if you didn't have a chance to see that one, please log on and get signed up for that one soon. And of course, I love being public. People love hearing me talk. I got a face for radio, as they do say. But also I have had a lot of published articles throughout the last several years, as well as a published book, Cross the Bridge to Retirement. If you have not received a copy of that book, you can call or text that number or email, and we'd be more than happy to share that with you. Today's presentation will be divided into 3 sections. First, we're going to gain a better understanding of your emotions and how they can influence you in your decisions. Next, we'll discuss 5 of the most commonly and potentially costly mistakes that people make and how to avoid these areas in your portfolio. And finally, we'll highlight the key of managing emotions, staying calm, and potentially with greater success in varying market conditions. Let's start by exploring the role emotions play in the decision-making process. Many psychiatrists believe that people are hardwired to make irrational emotional decisions. Numerous studies have been concluded that shows evidence on this irrational behavior. Some of the most famous were conducted by Dr. Daniel Kahneman, one of the founding fathers of behavioral finance and the 2002 Nobel Prize Peace winner for economics. He's got 4 great articles. We'd be more than happy to share those with you in his statement and his books. So if you want to know more about Dr. Daniel, we'd be more than happy to share this stuff with you. When you combine a psychological bias, loss of aversion with emotions in investing in a volatile market, it can lead to costly mistakes. In fact, look at this cycle of emotional investing chart. In bull markets, when prices are going up, people technically experience upward swing emotions, going from optimism to excitement to overconfidence. But while this may be happy on the top of the market, this moment actually offers a greater risk of loss. The old adage, buy low, sell high, but many investors just do the opposite. They get so excited and overconfident they simply follow the crowd, investing at the top of the bull market just in time to see their portfolio values decline. On the other hand, in a down market, people may be overcome by fear and panic, selling their stocks at the market's bottom. However, this point of the equity market cycle actually provides people with the greatest opportunity for gains over time. As Dr. Daniel said, the more emotional event is, the less sensible people are. And that is 100% true. And if you think about that, it doesn't just go with the world of finances, it goes with day-to-day living, about anywhere from eating to watching TV to working to buying things. It's people do a lot of things mostly on emotion, and a lot of them don't make sense of what they did are. It's like the old proverbial, do you want it or do you need it? Now let's answer the question, the 5 most common and potentially costly mistakes that people make and how to avoid them. The first is impatience. In bull markets, some investors get impatient waiting for their money to increase in value. Then they try to enhance performance by trading more frequently, constantly moving in and out of equities in search of that higher returns. While this strategy can work if you pick the right stocks for the time in the market correctly, it also can lead to higher trading costs, more taxes, and lower returns. A more effective and consistent approach is to build a long-term financial plan that can help you stay vested through these changing market conditions. Many people don't have the patience to say it that way, though. How long do you think, and this is a great question and nobody's gotten it right yet, but how long do you think that most equity fund investors have remained in their investment for over the last 20 years? Only 4.19%. That's barely 20% of people have remained in their investment for the last 20 years. Why do they do that? Panic, and fear. So let's take a look at how emotions and patience can impact your portfolio's return. In their study of the investment behavior on impact and portfolio returns, Dalbar Inc., a leading investment research firm, showed that while equities performed well over the last 30 years, from 84 to 14, emotional decisions to buy, sell, switch in the market have led to average return of only 3.79%. In comparison, the S&P generated average returns of 11.6% over the same 30-year period. That's a difference of over almost 7.3% per year. Of course, it's important to keep in mind that investor returns reflect selection as well as sales charges, fees, expenses, and transaction costs, where the boardwalk of the S&P 500 returns do not. These factors also contribute to the difference in returns. The S&P 500 index is an unmanaged index which you cannot invest directly anymore, but past performance is not a guarantee of future results. Now you're going to hear me say that phrase a lot for disclosure purposes. You actually can invest in, for the record, in the S&P 500. It's called a benchmark index, where you just take the index of the S&P 500 and ride it out. So, but there are fees attached to that whatsoever. Why is following a plan so important? It can help you control your emotions in volatile times, such as staying focused on strategies and not using your emotions, keeping you from being distracted by the short-term movements of the equity market, allowing you to remain on track with your long-term goals. Now, of course, in the situation we're living in today, just this week alone, if you look at up 800, down 400, up 400, down 300, and then it's up a little bit today, you have a lot of roller coaster emotions. So you basically have to decide the plan of, what do you want to keep protect, what do you want to control, and what do you want to keep emotions out of it. Number 2 is overconfidence. It's another emotion that can cause you to potentially cost many mistakes. When you're overconfident, you ignore many key facts, relying on momentum or hot tips from a friend to help boost your portfolio's performance. By chasing performance through overconfidence, you can have unintended consequences. It can increase your risk of loss and potentially lower your returns over time. You can avoid this trap by diversifying your assets by selecting places based on research, not by emotions and hot tips. And if you're like a casino person like that, that when you get to a table and it's running well, and you stay there and you win a lot of money, and then it starts going flat, you still get overconfident, you keep on staying there, next thing you know it, you've lost all your money. Don't fall into that emotional trap. But when you do put your money in stocks and bonds, momentum can turn at any time. Follow the crowd, and you may end up buying at the top of the market right before the significant decline. For example, look at the two flows of assets in the mutual funds over this 15-year period. And I apologize for the dates going to 2014 because this was the cycle that we had for compliance purposes. We couldn't get the ones from 15 to 20, so apologize for that ahead of time. The two best years in terms of money invested in the stocks and bonds were 2001 and 2007, the top of the last two bull markets. They were followed by the two worst years in the stock market returns, with a negative 22 in 02 and a negative 37 in 08. Please note that stocks are represented by the S&P index, an unmanaged index large cap fund. They're subject to risk, including a possible loss of principal, and an indexes are manageable. Again, past performance is not a guarantee of future results. You guys are going to memorize that one by the time this is all over with. Here's another way of looking at the risks of chasing performance. If you make decisions based on last year's performance, you may be in for surprise. Investments perform well one year, but will not do as well as the next. For example, international stocks from the top asset classes in 2007 earning a little over 11%. But in 2008, returns dropped to the bottom of the rankings with a negative 43.38%. That's a big change. So one time someone says one thing doesn't mean it's going to change another one. An investment cannot be made directly in an index, and past performance is not guaranteed by future results. This is one of my favorite slides. It's like, rather than chasing performance, diversification can help generate the most consistent returns in any market. The gold boxes in this chart show the returns of a hypothetical diversified portfolio with assets that spread evenly among the 8 different categories. As you can see, it generated returns that were more consistent than any other asset classes over the last 20 years. A diversified portfolio can also provide you with a comfort level you need to stay vested through turbulent times and participate in long-term growth potential in equity market. Please again note that profit protects against market loss for past performances. But if you're looking at this chart here with the diversification of the Lays caps of stocks, large growth, large value, S&P, small caps, high yield, bonds, cash, and diversified portfolio, diversification is really good. Again, at the end of the day, it's what you keep that counts. I'll leave the screen on here because on Tuesday, people asked me many times, could you go back there because they wanted to take a screenshot of it or have it for their own personal gain to see what that is. But I challenge you, if you look at the orange box of bonds, look how many times it's in the bottom of the bucket versus all the way at the top. Quite a few times difference. The next emotion we're going to discuss, as we mentioned previously, was fear. In bear markets, investors are often reluctant to invest in equities because of earlier losses and fear that they may make more costly mistakes. Some delaying making choices and wait for definite signs of a market recovery before moving back into equities. While this approach may seem sensible at the time, it also can hinder the growth potential of your portfolio. In fact, the longer you wait to put in money into equities, the less chance you'll have to take advantage of that sale prices and a potentially market rebound. One way to address your fear is to consider easing back into the equity market using an automatic investing strategy like dollar cost averaging. By making fixed, regular choices, dollar cost averaging can help you reduce while increasing your exposure to growth potentials in equities. Dollar cost averages does not guarantee a profit or protect against loss in declining markets. That was a disclosure, which I have to go through a lot of these today. But how much fear can you impact on your portfolio's return? Research has shown that the bull markets are front-loaded. If you miss the first year of the rebound, you can lose out on nearly half of the average bull market's total gains. For example, the Lethen Group, a leading investment research firm, found that the Dow Jones average generated a median return of 41.8% in the first year of every bull market since 1900. That's almost half of the median gains of 85.5% for the 23 bull markets during this period. But again, past performance does not guarantee future results. You can reduce your fear and take the guesswork out of timing the market by using dollar cost averaging. Rather than trying to guess when today's bear market might end, Dollar cost averaging can help you increase your exposure in the equities market through fixed, regular places at a specific period of time. But putting your money in the same amount, no matter how the market is performing, dollar cost averaging can help reduce the average cost of your money and potentially enhance your returns. Consider this example on the slide. It compares a $40 lump sum investment with a one invested on 4 separate occasions of $40. When you invest in a single large purchase, you increase your chance to lose money in a volatile market. Here, a $40 lump sum investment buys 4 units at $10 apiece. If the unit price decreases to less than $10, your investment will drop. Now look at what happens in dollar cost averaging. By investing in 4 separate occasions, you can minimize the risk by getting into the market at the wrong time and potentially reduce your investment cost. That's because you buy more units when the price is low and less when the price is high. So in this example, unit prices fluctuated from $5 to $12, and you ended up buying 5.08 units at an average cost of $7.87. That's 21% lower than the unit cost of $10 for the lump sum investment. Plus, if the market goes back up, you're going to be better positioned to take advantage of that market growth with more units at cost. Panic can also lead into investment mistakes. This is number 4. In down markets, many people panic and sell in order to move their cash into other fixed income places and investments, which you've recently seen in the last couple months. While this move can provide you with short-term safety, it also can mean less long-term growth in your portfolio and potential shortfall in retirement income. How long can you avoid this trap? The key is to stay calm and use history as a guide to maintaining your long-term goal focus. You should realize that the cost of selling stocks can be high. While stocks can certainly drop in value over short term, they're also one of the few places that long-term growth potentially necessary for investors to reach their retirement goals. As you can see from the slide, $100,000 invested in stocks at the end of 1985 would have increased to 1.9 million and some change by the end of 2015, despite the worst recession since the Great Depression. The same amount invested in bonds and cash would have reached 709,000 and 299 respectively. That's a $1.6 million difference compared to cash. Again, keep in mind, past performance is not a guarantee of future results. I said that on Tuesday, and I think I slept my dream saying that all night long, and it put me to sleep. Excuse me, just get a little water. Here's another way of looking at cost of leaving the equity market. By constantly moving in and out of equities, investors may miss out on the market's best days and negatively impact their returns. For example, take a look at the impact of just missing 40 of the best investing days over a 20-year period ending in 2015. Excluding the 40 best days, the S&P index guaranteed return was negative 2%, compared to an overall return of 8.2% if the money were vested for the full period of time. That's a more margin of 10%. And of course, you should realize that guess what? Past performance is not a guarantee of future results. Oops. Here goes crazy machine again. Apologize. Here we go again. Okay, got it back. When it comes to equity investing, history is on your side. As you can see from this graph, despite war, recession, corporate scandal, and other financial crises, stocks have historically offered strong returns over time. Indeed, from 1925 to 2015, a $1 investment in large cap stocks represented the S&P 500 would have grown to an impressive $5,390. And guys, keep in mind that past performance does not guarantee future results. Well, looking back at some of these dips that we've had: war, depression, recession, Watergate, recession, dot-com bubble, a lot of different things, and now we're in the COVID-19 phase. Finally, let's talk about indiscretion. Sometimes investors stay in cash because they're not sure what else to do. They feel at the very least cash investments will help them protect their assets from market volatility. The problem is that cash investments won't help you offset the loss of purchasing power over time. With taxes and inflation, you may have a lot less to do than you expect. To avoid this trap, it's important to work with your financial professional to review your asset allocation mix on a regular basis. He or she can help you determine the appropriate amount of assets to keep liquid in your portfolio. It's true that cash investments like T-bills and money market funds can preserve your principal and provide you with liquidity in turbulent markets. But over time, they're unlikely to generate the returns needed to offset the impact of taxes and inflation. In fact, taxes and inflation, cash has an average annuitized return of 0.08% since 1926. And of course, past performance is not guaranteed of future results. The three-bucket model can be used to determine if you have the right investment mix for your long-term goals and help you make the adjustments when that's working. Think of how it works. Think of investing in these three investment buckets. You got your short-term bucket, your immediate-term bucket, and your long-term bucket. Helps you evaluate your needs and goals with these buckets in mind. Use these buckets to determine whether or not your money is allocated properly for your profile. For example, if you're building an emergency fund and you need money to pay for living expenses for 6 months or less, you should have your money in the short-term bucket like CDs and money markets and cash, which can offer principal guarantees, but limited historical returns are kind of low. However, if you need money that you won't need for 6 years or more, you might want to put it in greater risk reward potential. It's best to allocate those terms in the long-term bucket class that historically generated higher returns since 1926. The key is to allocate your money in the right buckets to help reach your financial goals. And then you can use things like CDs, cash, money markets, bonds, assets, annuities, stocks, annuities, and so forth, depending on what your risk tolerance is depending how much you want to put in each bucket. So we'll move on to the final section of the presentation, managing these emotions, strategies that can help you control your emotions in a turbulent market, which I think right now is pretty easy to say that we are in a turbulent market. So what are the keys of staying calm in uncertain markets? Well, first of all, it's knowledge, then strategy, then perspective. To help steady your emotions, it's important to understand how your money will react in different market conditions. It's also helpful to build a broad, diversified portfolio that offers you the opportunity to generate more consistent returns, regardless of which way the market is headed, and to develop the income plan that you will never outlive. In addition, it's beneficial to work with trusted financial professionals who do have the expertise, experience, and third-party objectivity to help keep things in perspective and guide you through difficult times. Keep in mind there may be different costs associated with different products and services offered by financial professionals that you do work with. So knowledge is power. I always say that on the radio every single time. And to understand your money and your portfolio, it's important to focus on these three key areas. Volatility and income, how your investment likely is to perform in turbulent markets, what is the effect of your retirement income. Then there's key benefits. You should have a clear idea what you're selecting as a choice in your portfolio. Is it for growth? Is it for income? Is it for protection? Or is there another alternative like legacy planning? The potential benefits. Before choosing money, you should understand the risks and potential drawbacks before putting money in that investment. Remember, the more volatile your choice, the greater the range of emotions you may feel, the more likely you're going to feel like you've made some costly emotional mistakes. In the next several slides, we'll take a look at the different types of choices and explore how your emotions may be impacted depending on which decision you decide to go with. Let's start with the most popular one out there, and it's called stocks, or we also commonly known as equities. And as you can see from this slide, equities represented from the S&P 500 have been very farly volatile over the last 10 years, with monthly returns averaging from 11% to nearly 17% negative. With these swings, you're more likely to experience emotions like fear and excitement with equities than with other less volatile choices. Your income is going to be more likely going up and down in value, and the potential for you to make more costly emotional mistakes during turbulent times may be higher as well. In terms of key benefits, equities offer growth potential, the opportunity to diversify your portfolio, and to spread it out risk the possibility of dividend income, depending on which stocks you choose. Dividend-paying stocks can provide you with a tax-advantaged qualifying dividends and currently taxed at a lower tax long-term capital gains tax, rather than a higher tax for individual ordinary income. But on the downside, equities offer no protection against market uncertainty. Stocks are subject to risk. You have the possibility of a loss of principal. The equities do not offer optional income guarantees and beneficiary protections that can help you feel more securely in difficult times. And also, they also have a lot of times high productive fees that you have to pay on a yearly basis, whether you go up or down. Some of these protection features may be important to you, depending again on your goals and your financial situation. Now we're going to look at bonds. As this graph on the slide shows, the volatility of bonds returns has been significantly lower than stocks over the last 10 years. As a result, the emotion that you feel will be smaller with these types of choices. In fact, bonds offer several key benefits for investors who are concerned about market volatility. With a fixed rate of return, bonds can help you protect your assets against market risk. Government bonds and treasury securities are also guaranteed by the U.S. government as a timely payment of principal and interest, and if held to maturity, often a fixed rate of return and principal value. Certain type of bonds offer tax advantages. For example, treasury securities are exempt from state and local income taxes, and municipal bonds issued by those states, cities, and counties and other government entities are generally exempt from federal income tax and sometimes from state and local taxes too. Municipal bonds may be subject to an alternative minimum tax as well. You got to consult your tax advisor for more information on that, as I'm not a tax advisor or CPA. We do have two here in the office next to us to answer those questions if needed. However, with the return of bonds may offer growth potential, you need to keep pace with inflation. And with rising costs, you could lose purchasing power on your retirement dollars. Plus, if the market goes up, you may experience regret and disappointment that you missed out on those growth opportunities. While bonds are not impacted by the market volatility directly, the value of these investments will be accredited by credit defaults and interest rate volatility. If rates rise significantly, investors may sell their bonds before maturity and lock in their losses. In addition, bonds don't offer death benefits or optional retirement income guarantees that are available in other certain products such as annuities, for which you may pay a fee or a charge. These annuity guarantees are backed by the claims paying ability of the insurer. We'll learn more about that in a little while. Next, third category we're going to discuss is cash, the easiest one to go over. Treasury bills, CDs, money markets, and other cash investments are popular among individuals looking for short-term financial security or to diversify their portfolio in a conservative rate. In terms of monthly yield, CDs are less volatile than equities or bonds. They offer a fixed rate of return if held to maturity, and if they're insured by the FDIC, T-bills are also backed by the U.S. government. These choices can help you stay calm in a volatile market, but unfortunately, they offer no potential for market growth. Plus, they offer no lifetime income options or no beneficiary protection features, both which might be important considerations depending on your individual needs and objectives. Finally, we'll discuss annuities, in particular fixed index annuities. Index annuities are long-term insurance products with guarantees backed by the claims paying ability by the issuing insurance company. An index annuity is not an investment in the stock market or any index. It offers you the opportunity to earn interest based on the past part of the performance of a specific market index. You can choose from a diverse index accounts for growth potential and a fixed interest account for guaranteed fixed rates and principal protection. All account options are in tax deferral mode. Of course, tax deferral is not unique to annuities, but however, you can benefit on tax deferral by investing in stocks, bonds, and qualified plans such as an IRA, a 401k, or 403b. However, unlike stocks, bonds, or cash investments, index annuities can help protect your retirement income from market losses. For an additional fee, they offer a living benefit rider that can guarantee your income for life to help insulate your legacy in a down market. Some riders even provide lifetime income that guarantees to rise for a certain number of years, even if your contract value drops to zero. By putting money in an annuity with a living benefit rider, you're comforted knowing that your income can be protected for life no matter how the market performs. And keep in mind, these guarantees are subject to restrictions and are backed by the claims paying ability of the insurer. Index annuities generally work in two stages. In the accumulation stage, they can help you grow assets on a tax-deferred basis. And in the distribution stage, they can provide you with a broad range of options, including annuitization, lifetime income payments, or even long-term care doublers. Mind you, withdrawals and taxable amounts subject to ordinary income tax, if taken prior to the age of 59 and a half, an additional 10% federal tax may apply. That's the disclosure. So basically, if you're not 59 and a half and your money is in an annuity, you might have to pay money, a fee to the government to take money out because of the tax deferral benefit that you've encountered. In taking steps to control your emotions, perhaps the most important strategy to build on is a broadly diversified portfolio and comprehensive financial plan that addresses your critical investment needs and goals, while helping reduce emotional risk. By spreading your assets among different vehicles like stocks, bonds, cash, and annuities, you can reduce the impact of one will have on the other in an overall portfolio and potentially generate more consistent returns. And with more stability comes less emotion, which can lead to big mistakes. In addition to stocks, bonds, cash, and annuities that we've already discussed, you could consider other products in your financial planning if you wanted to, such as mutual funds, real estate, life insurance, long-term care, and commodities. Again, taking on the risk part of that is what's there. To stay calm in turbulent markets, it's important to create a withdrawal strategy that can help ensure your taxes last for life. As the chart on the slide shows, you may run out of money if you take out too much each year. For example, your money will last for only about 20 years if you withdraw 8% per year. On the other hand, it could last for more than 30 years if your annual return rate is 4%. This is just a chart of returns of how much money you're receiving. And this is a big thing of what we're talking about next week in Income Savvy. If you want to ensure your income will last, you will need to withdraw with more than 4% a year. You may want to consider an indexed annuity with a living benefit rider for more guaranteed income for life. This table on the slide shows the probability your assets will last in a 30-year retirement with a 6% withdrawal rate and a 60-40 stock bond portfolio. You only have a 10 to 20% chance your money will last in that 30 years. And I hate to ask people about this, but if you walked on an airplane and they said, hey, we got a 10 or 20% chance of landing, would you stay on that airplane? Well, in contrast, an indexed annuity with a living benefit rider can provide guaranteed lifetime income withdrawals of not just 4%, but all the way up to 7% per year, depending on the product and the rider. Please keep in mind the living rider is generally available for an annual fee, which is reduced off of the death benefit. A living benefit rider guarantees a certain percentage, usually generally between 5 and 7%, can be withdrawn annually for life based on age. Keep in mind that annuities may not be suitable for individuals of all proportion and for a portion of your retirement assets, but discuss your situation with your financial professional on the amount of income you want, guarantees you deserve, and protection you are looking for. The third of staying calm in volatile times is to work with a financial professional or insurance agent that you can trust. And how you can find the right professional for your individual situations. I've been saying this all the time, and here's some questions to ask yourself. Does this person have the knowledge, experience, and expertise I'm looking for? Is he or she responsive to my needs and looking out for me as different than everybody else? Are they easy to get a hold of? Can I get a hold of them when I want to? Will they always respond to me when I do that? And has she been referred to me by someone else that I trust? Those are some good things to look at when you're looking at perspective. Something I can honestly say in my company here at Clear Income Strategies Group, that is what our focus is based on. A good financial professional can help you navigate the ups and downs of the world of portfolio. In good times, he or she can help you overcome the emotions like overconfidence and impatience and build an investment strategy with the right balance of risk and reward potential. While times are bad, he or she can help you stay focused on your long-term goals rather than your short-term returns. Simply put, are you looking for instant satisfaction or long-term gratification? My business, I'm always about long-term satisfaction. So let's work together to customize a creative strategy to help you smooth out your emotions in today's world. If you're interested, you may want to consider scheduling a time for a free portfolio review. I can help you evaluate your current portfolio and work with you to take care of emotions in a stress-free environment. These are the resources that we offer on our website. Know that we have a plethora of things we work with because we believe education is key. This is one of the attachments on the screen. You can pull this out and request any of these either through text, email, or a phone call, and we'll be more than happy to provide those for you. As I mentioned earlier, we have Income Savvy workshop coming up next week, Baby Boomer Basics, and some others coming on there on the website of donotlosemoney.com. If you'd like to schedule a meeting and you don't feel comfortable calling, you want to do it on your own because you don't know your schedule, we now are working with calendly.com/DolphJanis, where you can actually just schedule your appointment with me anytime you want, day or night, as the times available will be on the website. Again, thank you for taking the time this afternoon to listen to Emotions in the Market, and we appreciate you listening to us. We'd love to have you follow us on Facebook and our YouTube channels, as we're constantly posting up videos. And if you haven't belonged to our monthly newsletter, please refresh that for as well at clearincomeforlife.com. Again, you guys be safe out there. Get ready for phase 2 starting this weekend. Be safe, take care, and have a wonderful weekend and Memorial Day holiday. Take care. Bye-bye. Thanks again.